why BlackRock just moved $2.1 trillion out of America, and what it means for you. $2.1 trillion moved in silence, no explanations, no warnings, just cold, calculated repositioning by the world's most powerful asset manager. This has happened before, 3 times in modern history: 1928, 2006, 2010. Each time, the institutions moved first. Each time, they protected themselves. And each time, ordinary investors lost everything. The pattern is unmistakable. The timeline is chilling, 12 to 24 months. That's all the warning history gives. And if you're reading SEC filings right now, you'd see it's already begun. The question isn't if, the question is, will you see it before your wealth disappears? Welcome to Currency Analyzer. Now, if you've been around long enough, if you've built something real over the years, if you know that the most important financial warnings never come with sirens, then you're in the right place. Look, we're not here to entertain you. We're here to give you what matters: patterns, data, the kind of analysis that separates those who preserve wealth from those who watch it evaporate. So, do yourself a favor. Hit that subscribe button down below. Think of it like adding another trusted advisor to your team, except this one might actually tell you what you need to hear, not what you want to hear. And here's something else. Drop a comment right now. Tell us where you're watching from. Are you in New York, London, Tokyo, Dubai, Toronto? Because what's happening isn't isolated to one city or one country. This is a global capital shift. And we want to know, where are the people who can see what's really going on actually located? Now, let's get into it. In late November 2024, a document appeared in the Securities and Exchange Commission's public filing system. Form 13F, routine paperwork that institutional investors submit every quarter. Most people never read these documents, but those who did noticed something extraordinary. BlackRock, Incorporated, the world's largest asset manager, controlling over $10 trillion in client money, had restructured its portfolio in a way that hadn't been seen in decades. The numbers were striking. U.S. Treasury holdings reduced by $340 billion. Domestic equity exposure down 18% from the previous quarter. Corporate bond positions in American companies systematically decreased, and the money didn't just disappear. It moved. $2.1 trillion reallocated across global markets in just 8 months. European infrastructure funds increased by $420 billion. Asian equity markets up $380 billion in new positions. Emerging market sovereign debt, $290 billion in fresh capital. Commodity-backed securities and precious metals, $180 billion added. The rest distributed across Canadian real estate, Swiss financial instruments, and what analysts call geographic diversification vehicles. This wasn't a small adjustment. This was the largest peacetime capital reallocation by a single institution in recorded financial history. And it happened quietly, methodically, without a single press release explaining why. Now, BlackRock doesn't make moves like this on instinct. They employ over 1,400 risk analysts. They run quantitative models that process thousands of economic variables simultaneously. Their Aladdin risk management system, used by institutions managing $21 trillion globally, operates on probability-weighted scenario analysis. When BlackRock moves $2.1 trillion, it's not speculation. It's not a hunch. It's a calculated response to what their models are telling them about the future. But here's what makes this significant for everyone else. History shows a pattern. When institutions of this scale begin reducing exposure to their home country's assets, when they start moving capital across borders in massive quantities, something important is about to unfold. And that something typically materializes within 12 to 24 months. Consider what happened in 2006. Goldman Sachs, JP Morgan, several major Wall Street firms began quietly reducing their exposure to mortgage-backed securities. Their internal risk models had identified problems in the housing market. But publicly, these same firms were still selling mortgage products to clients, still rating them as safe investments, still encouraging retail investors to maintain exposure. The firms protected themselves first. By late 2007, their positions were largely secured. Then came 2008. The subprime mortgage crisis destroyed trillions in household wealth. Retirement accounts collapsed. Home values evaporated. But the institutions that had repositioned early, they survived. Some even profited. The lesson wasn't that these firms were corrupt, though some certainly were. The lesson was timing. Institutional capital moves first. Retail capital, the money held by individuals, small business owners, middle-class families, realizes the danger last. And that gap between institutional awareness and public awareness, that gap is where wealth gets transferred. Now, look at 2024. BlackRock's movement isn't happening in isolation. JP Morgan's latest quarterly filing showed a 12% reduction in U.S. Treasury positions. State Street Global Advisors decreased domestic equity recommendations to institutional clients. Vanguard adjusted allocation models for target date retirement funds, reducing U.S. exposure, increasing international diversification. Bridgewater Associates, the world's largest hedge fund, published research suggesting a 40% probability of significant dollar devaluation within 36 months. These aren't fringe players making emotional decisions. These are the largest, most sophisticated financial institutions on Earth, and they're all moving in the same direction, away from concentrated U.S. dollar exposure, toward geographic diversification, toward hard assets, toward what financial analysts call defensive positioning. So the question becomes obvious. What do they see? What are their models telling them that the general public isn't hearing? Because here's the reality. When one manages money at institutional scale, when one's fiduciary duty requires protecting billions or trillions in client capital, one doesn't move based on newspaper headlines. One moves based on structural analysis, debt trajectories, currency dynamics, demographic trends, political stability indicators, monetary policy constraints. And when all those variables align in a particular way, when the models start flashing the same warning signals across multiple scenarios, one acts. One doesn't wait for confirmation. One doesn't wait for consensus. One protects capital first, explains later. That's what $2.1 trillion moving out of America represents. Not panic, not speculation. Institutional-grade risk management responding to probability-weighted assessment of what comes next. And if history is any guide, what comes next matters greatly for anyone holding wealth in dollar-denominated assets, which, for most people, is everything they own. March 1928. A private meeting took place in the Manhattan offices of JP Morgan and Company. The room was small, paneled in dark mahogany, with windows overlooking Wall Street below. No minutes were recorded. No journalists attended. No public announcement followed. But what happened in that room would matter more than any headline published that year. The Morgan partners, along with representatives from the Warburg banking family and the Rothschild interests, made a collective decision. They would begin reducing equity exposure, systematically, quietly, without alarming the market. The decision wasn't based on pessimism, it was based on mathematics. Their internal analysis showed American stock valuations had detached from underlying corporate earnings. Price-to-earnings ratios were approaching levels never before seen in modern markets. Margin debt, borrowed money used to buy stocks, had reached unprecedented levels. The numbers didn't work anymore. So they moved. Over the next 18 months, these families shifted billions in 1928 dollars out of equities, into gold, into foreign bonds, into liquid cash positions. Meanwhile, the stock market continued climbing. The public poured money in. Newspapers celebrated new highs every week. Economic advisors assured everyone that prosperity would continue indefinitely. Even President Hoover declared that poverty would soon be eliminated entirely. The institutions said nothing. They just kept selling, while retail investors kept buying. October 24th, 1929, Black Thursday, the market collapsed. By 1932, the Dow Jones had lost 89% of its value. Entire fortunes, built over generations, vanished in months. Families lost everything. But those banking families who had repositioned in 1928, they survived intact. Some even expanded their holdings, buying assets at depression prices. The pattern was established. Institutional capital exits early. Retail capital realizes the danger after it's too late to escape. Now, move forward 78 years. 2006. Goldman Sachs created a trading desk with one specific purpose: bet against the mortgage market, not just avoid it, actively short it. They hired analysts to identify the worst performing mortgage-backed securities in the market. Then they created financial instruments designed to profit when those securities failed. This wasn't public knowledge, this was internal strategy, visible only to those reading the fine print of SEC filings. By early 2007, Goldman had accumulated massive short positions against subprime mortgages. They'd protected their own capital. But here's what makes this case particularly instructive. At the exact same time Goldman was building these short positions, their sales division was still selling mortgage-backed securities to clients. Pension funds bought them. University endowments bought them. Individual investors, through mutual funds, bought them. And Goldman's public statements remained optimistic about the housing market. No warnings issued, no alerts sent to retail clients. The firm protected itself first, then let market forces handle everyone else. July 2007. Bear Stearns, a major Wall Street firm, announced 2 of its hedge funds had collapsed. The reason? Mortgage-backed security losses. Still, most analysts called it an isolated incident. March 2008, Bear Stearns itself collapsed. Acquired by JP Morgan in a forced weekend sale. September 2008, Lehman Brothers filed for bankruptcy. The entire financial system nearly collapsed. Trillions in household wealth evaporated. Retirement accounts lost 50% of their value. Home prices crashed. Unemployment spiked. The institutions that had repositioned in 2006, 2007, they took losses, but survived. Goldman Sachs even received government bailout money, then paid it back within months and returned to profitability. The retail investors who stayed fully exposed through 2007, many never recovered. The gap between institutional awareness and public awareness cost ordinary people decades of savings. Third case, European debt crisis. Most people remember it as a sudden shock. Greece on the verge of default, Ireland, Portugal, Spain facing potential collapse. But the smart money saw it coming years earlier. Swiss banking institutions began reducing exposure to Southern European sovereign debt in 2008. Not 2010, when the crisis went public, 2 full years before mainstream recognition. Deutsche Bank restructured its sovereign debt holdings in 2009, reducing Greek, Italian, Portuguese positions. BNP Paribas, France's largest bank, quietly decreased exposure to PIIG as nation bonds throughout 2009. These moves appeared in quarterly filings. They were public information, but they weren't news. No financial journalists wrote about them. No analysts flagged them as warning signals. The institutions just moved silently, systematically. Then came 2010. Greece revealed its debt situation was far worse than officially reported. Bond markets panicked. Yields on Southern European debt spiked. The euro currency faced existential crisis. Retail investors holding European bond funds, pension funds with sovereign debt exposure, they absorbed massive losses, but those Swiss banks that had repositioned in 2008, they'd already moved to safety. 3 separate cases, 3 different decades, 3 different asset classes, equities, mortgages, sovereign bonds, but the exact same pattern. Institutional money identifies structural risk through mathematical analysis. Institutional money repositions before public awareness. Institutional money protects itself first. Then the crisis materializes, usually 12 to 24 months after institutional exodus begins. And retail capital, the money held by individuals and small institutions, bears the losses every single time. This isn't conspiracy. This is simply how information flows in financial markets. Large institutions have better data, better models, better analysts, and a fiduciary duty to protect capital above all other considerations. They move when their models tell them to move, not when newspapers confirm the danger, not when the public reaches consensus, when the mathematics change. So when BlackRock moves $2.1 trillion out of American assets in 8 months, when JP Morgan reduces treasury holdings, when Vanguard restructures allocation models, when Bridgewater warns of dollar devaluation, the pattern isn't new. It's the same pattern that played out in 1928, in 2006, in 2010. Institutional capital is moving first. Again, the only question that matters now, what did their models identify this time? The analysts at BlackRock don't make decisions in boardrooms with dramatic presentations. They make decisions in front of computer screens, running probability models, feeding in data streams from hundreds of sources simultaneously, economic indicators, debt trajectories, currency flow patterns, demographic projections, political stability metrics. The computers process it all, assign probability weights, generate risk scenarios. And sometime in early 2024, those models started showing something concerning. Not one isolated risk factor, 4 separate structural problems, converging simultaneously, each one significant on its own, together. They created what risk managers call a compound probability event, the kind that doesn't happen often. But when it does, it changes everything. First variable, the debt mathematics, December 2025, United States federal debt, $36.4 trillion. That number increased by $2.3 trillion in just 11 months. But the total debt figure, that's only part of the equation. What matters more is the ratio, debt compared to the size of the economy that has to service it. Current U.S. debt to GDP ratio, 132%. That means for every dollar the American economy produces, the government owes $1.32. Now, that might sound manageable, but consider the interest cost. At current rates, the U.S. government pays over $1.1 trillion per year, just in interest. Not paying down debt, not reducing the principal, just interest. That's more than the entire defense budget, more than Medicare spending, more than most cabinet-level departments combined. And here's where the mathematics become problematic. Interest costs are growing faster than GDP growth, which means every year, a larger percentage of government revenue goes purely to servicing existing debt, less available for anything else, defense, infrastructure, social programs, everything gets squeezed. But the debt doesn't stop growing. It accelerates because the government still runs annual deficits, meaning they borrow more each year just to fund basic operations. So the debt grows, which means interest costs grow, which means deficits grow larger, which means more borrowing. It's a mathematical spiral. And BlackRock's models understand something crucial about this spiral. History shows what happens when sovereign debt crosses certain thresholds. Britain in 1945, debt to GDP hit 130%. Within 25 years, the pound lost reserve currency status. France in the 1920s, debt exceeded 150% of GDP. The franc collapsed, required complete monetary restructuring. Japan in the 1990s, debt began climbing past 100%. 30 years later, they still haven't escaped the deflationary trap. The pattern is mathematical. Once debt trajectories reach certain levels relative to economic output, only two outcomes exist. Either the government implements severe fiscal discipline, cuts spending dramatically, raises taxes substantially, and pays down debt over decades. Or they print money. They monetize the debt through inflation. They devalue the currency until the debt becomes manageable in nominal terms, while destroying purchasing power for everyone holding that currency. History shows which option governments typically choose. They print. Every time. Second variable, the de-dollarization acceleration. For 70 years, international trade operated on one assumption. If one wanted to buy oil, one needed dollars. If one wanted to purchase commodities, one needed dollars. If one wanted to settle major transactions, one needed dollars. The dollar wasn't just America's currency, it was the global reserve currency, the foundation of international commerce. That system created automatic demand for dollars. Every country needed dollar reserves. Every central bank held U.S. treasuries. Every trading nation accumulated dollar-denominated assets. This demand allowed the United States to run perpetual trade deficits, to borrow cheaply, to maintain lower interest rates than debt levels would otherwise allow. The reserve currency status was, in effect, an economic superpower. But in 2023, something shifted. China and Brazil announced bilateral trade settlement in yuan, not dollars. India and Russia began settling energy purchases in rupees. Saudi Arabia. For decades, the cornerstone of the petrodollar system indicated willingness to accept yuan for oil sales. The BRICS nations, Brazil, Russia, India, China, South Africa, representing 45% of global population and 35% of global GDP, announced development of alternative payment systems, systems designed specifically to bypass dollar transactions. By late 2024, over 20% of global oil transactions were settling in non-dollar currencies. That figure was 2% in 2020. The shift is accelerating, and BlackRock's models understand what this means. Reduced dollar demand equals reduced demand for dollar-denominated assets, which means reduced demand for U.S. treasuries, which means reduced foreign investment in American markets, which means the United States can no longer rely on automatic foreign capital inflows to fund its deficits. The data confirms this is already happening. China held over $1 trillion in U.S. treasuries in 2013. Today, $760 billion. They've reduced holdings by nearly 25%. Japan, the largest foreign treasury holder, reduced positions by $220 billion since 2022. Saudi Arabia, selling. Belgium, reducing. Switzerland, decreasing exposure. Central banks globally are diversifying away from dollar concentration. Not rapidly, not dramatically, but consistently. And BlackRock's models project this trend continuing, potentially accelerating. Third variable, the demographic divergence. Economic growth ultimately depends on two factors: labor force size, productivity per worker. The United States faces challenges on both fronts. Birth rates have been declining for decades. The working age population is growing at the slowest rate since the 1930s. Social Security actuarial tables project the ratio of workers to retirees will decline from 2.8 to 1 currently to 2.3 to 1 by 2035. Fewer workers supporting more retirees. Meanwhile, productivity growth has slowed. Average annual productivity gains in the 1990s and early 2000s. Around 2.5% last decade, under 1.5%. Less labor force growth plus slower productivity gains equals slower economic growth. Now contrast that with emerging markets. India's median age, 28 years old. United States median age, 38 years old. Indonesia, Vietnam, Philippines, all have younger populations entering peak productive years. These nations are also seeing rapid productivity gains, adoption of technology, infrastructure development, education improvements. From a pure capital allocation perspective, the mathematics favor younger, faster-growing economies. BlackRock's models calculate expected returns over 20, 30-year time horizons. And on that timeline, demographic trends matter enormously. Capital flows toward growth, always has, always will. Fourth variable, the policy trap. The Federal Reserve faces an impossible situation. If they raise interest rates to combat inflation, they make the $36 trillion debt increasingly expensive to service. Every percentage point increase in rates adds hundreds of billions to annual interest costs, which increases deficits, which requires more borrowing, which puts upward pressure on rates. But if they keep rates low, or worse, cut rates, they risk inflation acceleration. More inflation means dollar devaluation, which means foreign holders of dollar assets lose purchasing power, which means more foreign selling, which means more pressure on the currency. The Fed is trapped between two bad options. Neither leads to positive outcomes. This is the same trap the Bank of England faced in the 1960s and 70s. They couldn't raise rates enough to defend the pound without crushing their economy. They couldn't lower rates without triggering capital flight. They tried to thread the needle, they failed. The pound lost reserve status. 4 variables: unsustainable debt trajectory, accelerating de-dollarization, demographic disadvantage, constrained monetary policy, each one significant. Together, they create what BlackRock's models identified as a high probability scenario for significant dollar weakness over the next 24 to 36 months. Not certainty, probability. But when one manages $10 trillion in client money, a high probability is enough. One doesn't wait for certainty. One positions defensively when the mathematics shift. That's what $2.1 trillion moving out of America represents. Not panic, probability-weighted risk management. Right now, somewhere in America, a business owner sits in his office, 52 years old, built a successful manufacturing company over 23 years, $18 million in annual revenue, 12 employees. His wealth, almost entirely in 3 places: commercial real estate, the building his company operates from, retirement accounts, mostly U.S. stocks and bonds, cash savings, sitting in dollar-denominated bank accounts. He's done everything right according to conventional wisdom, worked hard, saved diligently, invested conservatively. But he's never stopped to ask one critical question. What percentage of his wealth would survive if the dollar lost 30% of its value? The answer, uncomfortable as it might be, is that most of it wouldn't. Real estate values are denominated in dollars. Retirement accounts hold dollar-based assets. Cash savings are pure dollar exposure. If the currency weakens significantly, all 3 lose purchasing power simultaneously. This isn't theoretical. This is mathematical reality. And this is the situation most business owners, professionals, and middle-class families face right now: concentrated exposure to a single currency without realizing it's a risk factor. And when BlackRock moves $2.1 trillion, they're not abandoning America. They're reducing concentration risk, and that distinction matters. Because the appropriate response isn't panic. It's not selling everything and moving to another country. It's simply doing what large institutions do: spreading risk across multiple jurisdictions and asset classes. First consideration, asset allocation rebalancing. Most investment portfolios hold primarily domestic assets: U.S. stocks, U.S. bonds, U.S. real estate. This made perfect sense for decades when the U.S. was the undisputed economic superpower and the dollar's reserve status was unquestioned. But if major institutions are now reducing that concentration, the logic for individual investors has changed too. Geographic diversification isn't about abandoning American assets. It's about not having 100% exposure to American asset performance. Practical implementation: international equity funds provide exposure to European, Asian, and emerging market companies. Foreign bond funds offer exposure to other developed economy debt instruments. These aren't exotic investments. They're standard asset classes available through any major brokerage. The question is simply allocation percentage. If an investor currently holds 95% domestic and 5% international, perhaps that ratio deserves reconsideration. Not switching to 5% domestic and 95% international, but maybe moving toward 70-30 or 60-40, reducing concentration without abandoning the home market entirely. Second consideration, hard asset incorporation. Institutions are increasing positions in assets that can't be printed by central banks: gold, silver, commodities, infrastructure. These assets have one critical characteristic: their value doesn't depend entirely on any single government's fiscal policy. Gold has maintained purchasing power across civilizations for thousands of years, not because of industrial use, not because of jewelry demand, because it's a store of value that exists outside any particular monetary system. When currencies weaken, gold typically maintains or increases value in nominal terms. This doesn't mean converting entire portfolios to gold bars, but it does suggest that having some percentage, 5%, 10%, 15%, in hard assets provides insurance against currency devaluation. For individuals, This can be accomplished through gold and silver exchange-traded funds, commodity index funds, infrastructure investment trusts, real assets that generate returns independent of currency strength. Again, not abandonment of traditional assets, simply diversification across asset types. Third consideration, business model resilience. For entrepreneurs and business owners, currency exposure extends beyond personal wealth. It affects business operations. A company that generates 100% of revenue in dollars, purchases all inputs in dollars, and maintains all assets in dollars, faces the same concentration risk as that individual portfolio. If the dollar weakens significantly, costs for imported materials rise, but the company can't raise prices because competitors face the same pressure. Profit margins compress, business value declines. The institutional response to this risk is revenue diversification. Companies that can generate revenue in multiple currencies. Companies that can serve international markets. Companies that can shift sourcing across borders. These businesses have flexibility. For a small manufacturer, this might mean exploring export opportunities. For a service business, it might mean acquiring international clients. For a consultant, it might mean offering services that aren't geographically constrained. The goal isn't to become a multinational corporation overnight. The goal is to reduce the percentage of business value tied exclusively to domestic economic performance. Even shifting from 100% domestic to 80% domestic and 20% international exposure. The 20% provides optionality. Fourth consideration, debt management in rising rate environments. One pattern across all three historical examples, Spain, Britain, Japan, is what happens to over-leveraged entities when monetary policy shifts. As governments struggle with debt, interest rates become increasingly volatile, sometimes spiking. As central banks try to defend currency value, sometimes crashing, as governments try to reduce debt service costs. But the volatility itself creates danger for highly leveraged businesses and individuals. A company carrying significant variable rate debt, a business owner with adjustable rate mortgages, they're exposed to interest rate volatility. If rates spike, debt service costs spike. Cash flow gets squeezed. Options narrow. The institutional approach is deleveraging before volatility arrives. Paying down variable rate debt. Refinancing into fixed rate structures where possible. Reducing overall debt loads to levels that remain serviceable even if rates move significantly. This isn't exciting financial strategy. It's boring defensive positioning, but boring and defensive is what preserves capital during transitions. Fifth consideration, liquidity maintenance. When institutions reposition, they prioritize liquidity, the ability to move capital quickly when opportunities arise or when risks materialize. For individuals, this means maintaining accessible cash reserves despite inflation concerns. Yes, cash loses purchasing power during inflation, but cash provides optionality. It allows purchasing assets when prices crash. It allows moving quickly when strategic opportunities appear. It prevents forced selling of long-term holdings to meet short-term needs. Illiquid assets, real estate, private equity, locked retirement accounts, they trap capital exactly when mobility matters most. The balance isn't holding 100% cash. That's wealth destruction during inflation. But holding 10 to 20% in liquid reserves, that's strategic flexibility. Sixth consideration, timeline awareness. The pattern from historical cases shows institutional movement precedes broad market impact by 12 to 24 months. Major institutional reallocation became visible in late 2024. If the pattern holds, broader market effects would likely materialize sometime in 2025, 2026. Not certainty, probability. But if that probability is high enough, the window for rational repositioning is measured in months, not years. This doesn't mean making dramatic moves immediately. It means beginning the assessment process now. Reviewing current exposure. Considering allocation adjustments. Implementing changes gradually, systematically, rationally. The mistake isn't moving too early. The mistake is waiting for mainstream confirmation, which arrives after optimal positioning windows close. That business owner sitting in his office, he can't match BlackRock's resources, can't employ 1,400 risk analysts, can't access the same data streams, but he can match their logic. Institutional capital is reducing concentrated dollar exposure. Institutional capital is diversifying geographically. Institutional capital is increasing hard asset positions. Institutional capital is managing debt conservatively. Institutional capital is maintaining liquidity. These aren't secrets. These are documented positions, visible in public filings. The question isn't whether institutions are repositioning. The question is whether individuals will recognize the pattern and respond proportionally. Because here's what history proves consistently. Economic transitions don't destroy everyone equally. They destroy the unprepared. Those who ignore pattern recognition. Those who wait for certainty before acting. Those who maintain concentrated exposure because it worked in the past. But those who see structural shifts early who position defensively before consensus, who reduce concentration risk when the mathematics change. They don't just survive transitions, they emerge positioned for whatever comes next. BlackRock moved $2.1 trillion for a reason. The reason isn't secret. It's probability-weighted assessment of 4 converging structural risks: unsustainable debt trajectories, accelerating de-dollarization, demographic divergence, constrained monetary policy. These variables are public information. The models are running on documented data. The pattern is visible to anyone willing to look. The choice, as always, belongs to the individual. Ignore the pattern and hope it's different this time, or recognize the mathematics and position accordingly. One approach has worked throughout history. The other has consistently failed. The only question that remains: which approach will be chosen this time?